Welcome to the deep dive. Today, we're taking a really granular look at the Dollar Tree story.
We are. Specifically, their Q3 fiscal 2025 results, which cover the 3 months ending on November 1st.
And you've probably followed their strategic repositioning for a while. Well, this feels like the moment of truth is here.
It really is. This is the first full set of results where the focus is exclusively on the core Dollar Tree segment.
Right. The old Family Dollar assets are now officially classified as discontinued operations. So our mission here is to really dissect the early returns on their most ambitious gamble.
The Dollar Tree 3.0 multi-price strategy.
Exactly. Is this pivot actually proving profitable, or is it, just generating a lot of complexity?
It's absolutely fascinating to watch this play out because the initial top-line numbers, from continuing operations, they are undeniably strong.
Okay, so give us the headline.
Net sales for Q3 jumped 9.4% year over year, came in at $4.7 billion.
And the bottom line?
On the bottom line, diluted EPS from continuing operations hit $1.20, with adjusted EPS just a cent higher at $1.21.
So that's an 11.1% increase in GAAP EPS. That's a powerful signal right out of the gate that this leaner focus is working.
It's generating momentum for sure.
Okay, so let's unpack that growth. In retail, the first metric you always check is comparable store sales, comp sales.
Right.
The Dollar Tree segment achieved 4.2% comp growth in Q3. That's solid, but when you look under the hood, the composition of that 4.2%, it tells the entire story.
It absolutely does. The total growth figure is actually concealing the tightrope walk that management is on.
How so?
That 4.2% growth was driven overwhelmingly, in fact, entirely by a massive 4.5% increase in the average ticket.
So customers are spending significantly more money every single time they check out.
Exactly.
That sounds like a clear win for the multi-price point strategy.
It is a win, absolutely, but
they successfully convinced shoppers to put more expensive goods in their basket.
they did. But here's the strategic tension, right? That substantial ticket bump actually masked a slight contraction in customer traffic. It was down 0.3% for the quarter.
So fewer people came in, but the ones who did bought much bigger baskets.
You got it.
So that traffic decline is the counterweight, isn't it? It suggests that pushing prices beyond that traditional $1.25 core might be shedding some of the most price-sensitive customers.
That's the exact risk they're running. Now, for some important context, if you look at the year-to-date figures, customer traffic is still positive. It's up 1.8%.
Okay, so this is a new development.
It's an inflection point we have to monitor really closely. If that negative traffic trend continues, management has to prove that the increase in profit per transaction more than makes up for losing that foot traffic.
And based on the merchandise mix, it looks like that average ticket gain is clearly tied to selling higher margin items.
No question.
The data shows discretionary comp growth, things like seasonal decor, general merchandise. That was at 4.8%.
Which comfortably outpaced consumables comp growth, so things like food and household supplies. That only grew at 3.5%.
So the shifting mix, that's the immediate strategic payoff.
It is. The discretionary mix increased by 40 basis points, and now it represents 50.5% of total sales. This is so crucial because those discretionary items, they generally have a significantly higher gross margin than the low-margin consumables.
So the whole multi-price system is designed to introduce enough compelling, higher-priced discretionary stuff to pull that overall mix toward more profit.
That's the plan. And it's working.
And here's probably the most compelling piece of evidence that this high-price strategy is working. It's kind of buried in the Halloween assortment data.
Oh, this data is staggering. It's a comparison that I think justifies the entire strategic shift.
So what did they do?
Management indexed performance back to 2022 levels, setting them at 100. And just look at the merchandise performance for items priced over $2. Merchandise gross profit dollars for that category soared at an index of 373.
Wait, 373?
373. It's explosive growth.
Oh.
And when you compare that 373 index for the over $2 items to the all items index, which was only 123, you realize that the higher price tiers are generating just a disproportionate amount of profit per unit sold.
So it's not just a theory.
Not at all. The sales trend for those items over $2 was indexed at 230. It shows that customers are embracing and actually buying these higher priced goods at scale. The average ticket growth is a direct realized benefit of this strategy.
That concentration of profit is what gives them the firepower. Okay,
Yeah.
so let's transition from revenue to costs. Generating sales is only half the battle,
Yeah,
right?
you have to know what it costs to get there.
And the good news continued on the gross margin line. It expanded 40 basis points to 35.8% for the Dollar Tree segment in Q3.
Yeah, the margin expansion was a testament to their new pricing power. The segment saw a decrease in its cost of sales rate, driven by a few things. First, improved mark-on from the pricing initiatives.
Okay, can you quickly define mark-on in this context for everyone listening?
Sure. Mark-on is essentially the difference between what Dollar Tree buys the merchandise for and what they sell it for, before you factor in any discounts or other costs.
So by adding $3, $4, $5 items, they immediately improve that percentage.
Instantly.
Yeah.
Add to that the favorable mix shift toward the higher margin discretionary goods, and then they also benefited from lower freight costs, which has been a tailwind for most retailers lately.
But it wasn't a totally clean win on the margin side. What pressures were they up against?
They faced three key headwinds. First, higher tariff costs, which is still a geopolitical reality. Second, increased markdowns, which we'll come back to. And third, unfortunately, higher shrink costs.
And shrink, for those who don't know the retail term, is inventory lost from theft, damage, administrative errors.
All of the above. And the fact that it's rising is a worrying counter trend against all these other wins. It's a systemic issue for the whole industry right now.
You mentioned markdowns. I know this quarter included a specific, very large action that management took.
It did. It directly impacted profitability. The Q3 results included a $56 million write-off of a bunch of slow-turning SKUs.
$56 million. That is a massive one-time inventory hit. What does that signal to you?
Well, this isn't an accidental loss. This is management cleaning house, a calculated, strategic write-off. They are literally purging old, ineffective inventory that doesn't fit the 3.0 vision.
To make shelf space for the better stuff.
To make precious shelf space for the higher-performing, higher-margin multi-price assortment. It's a move that cleans up the balance sheet, but it definitely added pressure on the margin through those markdowns. A steep, but I think necessary price to pay.
Okay, now we move to the cost of doing business, the operating expenses. This is where the strategic commitment really hits the financials.
It is. The selling, general, and administrative expenses, SG&A, that rate spiked significantly.
How much?
It jumped by 140 basis points on a GAAP basis, landing at 29.2% of total revenue. If you want to know where the multi-price money is going, look right here.
So what are the main drivers?
It's all directly related to the massive investment in the new system. You've got higher store payroll, which you need to support the new pricing and just cover wage increases.
Makes sense.
Then there are increased general liability claims costs and significantly higher depreciation expense. That comes from the thousands of store conversions and all the infrastructure investments they've made.
Okay, wait, let me make sure I understand the core strategic tension here. You're saying they achieved a higher gross margin because the pricing strategy worked.
That's right.
But their operating expenses soared even higher because of all the strategic spending.
That is exactly right. Dollar Tree is deliberately sacrificing short-term operational efficiency to fund the infrastructure and the labor that they need for this multi-price future.
And what was the net effect of that, all that calculated spending?
Well, the net effect was a contraction in the adjusted operating margin. It pulled back 30 basis points to 7.3% in Q3.
So that confirms the narrative.
It really does. They are accepting a temporary squeeze on operating profit now because they believe the long-term margin gains from all these 3.0 conversions will be even greater later on.
That brings us perfectly to those physical investments. Let's talk about the concrete steps they're taking to build out this future, the footprint, and the supply chain.
The rollout is aggressive. They opened 106 new Dollar Tree stores in Q3, bringing the total count to 9,269.
But the conversion rate is the really key metric here.
It is. They completed 1,744 multi-price 3.0 format conversions just year to date. That keeps them right on track to hit their full-year target of 2,000 conversions.
And at the same time, they're converting those leftover Family Dollar assets into the higher-performing Dollar Tree format.
Precisely. They converted 55 Family Dollar combo stores into full Dollar Tree stores just during this quarter. And this investment, it's demonstrably driving better use of their assets.
How can you tell?
Sales per square foot measured over the last 12 months, it rose from $233 to $236 year over year. The stores are, on average, just working harder.
And to support all this growth and the new complexity of multi-price items, they're making some massive capital-intensive bets on the supply chain.
Oh, this is huge long-term commitment. They announced plans for a new distribution center in Marietta, Oklahoma.
Right, that's the one that replaces the facility that was tragically destroyed by a tornado back in fiscal 24.
Correct. That's expected around spring 2027. But maybe even more indicative of their ambition is the purchase of a colossal 1.25 million square foot DC near Phoenix. That's slated to open in spring 2026.
A 1.25 million square foot facility. I mean, that is a massive capital deployment. It signals more than just growth. It's a profound commitment to optimizing their distribution.
It is. And speaking of efficiency, despite all this expansion and transition, one operational metric really shines through. They successfully reduced inventory by 5% year over year.
$143 million decrease.
Exactly. And that reduction happened while sales and the store count were growing, which indicates substantially improved inventory management.
Which suggests that painful inventory write-off we talked about and the focus on higher turning SKUs is already bearing fruit. It's tightening up operations.
It seems to be.
Now, before we move on to the outlook, you mentioned a specific non-operating item earlier in the year that provided a bit of a financial cushion.
Yes. Just for context, they recognized a pretty significant non-operating insurance gain of $62 million back in Q1. This was for the insurance recovery from the Marietta, D.C. tornado.
So not part of operating performance, but it certainly helps with overall financial flexibility.
Absolutely.
Okay, so turning to financial health and capital returns. The company has been incredibly active in returning capital to shareholders, which shows a lot of confidence.
They've been very aggressive with their share repurchases. Year to date, they bought back 16.7 million shares for $1.5 billion.
At an average price of about $90 a share.
Right. And to put that in perspective, that represents 8% of the shares outstanding at the beginning of the year. I mean, that is a massive return to capital. It says management believes their stock is undervalued relative to the potential of this 3.0 strategy.
And they also secured some additional financial maneuvering room recently.
They did. After the quarter ended, they increased their ability to borrow short-term capital. They boosted their commercial paper program from $1.5 billion up to $2.5 billion.
That's a big jump.
It is. It shows a commitment to maintaining liquidity when you're undertaking such heavy capital spending. We should also note that year-to-date free cash flow from continuing ops stood at a respectable $88.2 million.
So given all these investments, the conversions, labor costs, DCs, the buybacks management must feel highly confident because they just raised their full-year forecast.
That is the ultimate vote of confidence, right?
Yeah.
The updated fiscal 2025 outlook, it confirms they expect this momentum to continue. The full-year net sales outlook was revised up, now targeting between $19.35 and $19.45 billion.
And the comparable store sales growth is getting a bump too.
It is. The full-year comp growth outlook was raised to a range of 5.0% to 5.5%, and maybe the most crucial metric for investors. Full-year adjusted EPS from continuing operations was raised to a range of $5.60 to $5.80.
So they're expecting the profit concentration from the higher price points to overcome that investment drag on SG&A for the full year.
That's the bet. And they're also setting a very strong expectation for the peak Q4 holiday shopping period.
Always critical.
For Q4, they expect comp sales growth of 4.0% to 6.0% and adjusted EPS between $2.40 and $2.60. Essentially, the store-level investments are generating the sales and profitability they need to fund the big back-end expansion.
So the undeniable key takeaway from this deep dive really is that Dollar Tree's calculated risk seems to be paying off.
I think that's fair to say.
The multi-price strategy is successfully generating massive profit per transaction. It's allowing them to raise their full-year EPS outlook despite those heavy necessary investment costs in payroll and depreciation that are driving up the SG&A rate.
They are sacrificing short-term operational margin for long-term gross margin stability. It's a classic playbook.
It is. So let's end with this.
That summarizes the strategic trade-off perfectly. But here is the provocative thought for you to consider as Dollar Tree moves forward. The core of their success is that dramatic increase in average ticket. That's what's currently compensating for the slight decline in traffic.
Right.
So the long-term durability of the Dollar Tree 3.0 model, it hinges entirely on whether they can continue to attract customers who buy higher-priced items without alienating their core, budget-conscious customer base and pushing traffic further into the negative.
So that's the central challenge, the delicate balance between ticket growth and customer retention.
That is the tightrope.
A tightrope walk indeed. Thank you for joining us for this deep dive. We look forward to exploring the next set of sources with you soon.